Right now, as of 10:49 a.m. Eastern Standard Time on Tuesday, December 9, 2025, Intel Corporation, ticker symbol INTC, is trading live at exactly $40.31. We are looking at a fractional intraday move, holding green by just 1 cent, or roughly 0.025% on the session. But do not let that flat number fool you. The sheer stability at this $40 level is the loudest signal the market has offered in 18 months. For a stock that was effectively left for dead, ridiculed as a value trap, and written off by nearly every major institutional desk on Wall Street less than a year ago, holding the $40 line is not just a technical victory, it is a psychological fortress. The expectation for Intel has been a slow, painful drift into irrelevance, a legacy player suffocating under the weight of its own manufacturing delays while nimble competitors ate its lunch. The reality, however, is slapping the bears in the face. We are no longer watching a company in free fall. We are watching a massive industrial ship that has stopped taking on water and is slowly, painfully, but undeniably turning its engines back toward open ocean. The narrative has shifted from survival to revival, and the market is scrambling to price in a future that nobody thought was possible. If you are looking at the tape today, you are seeing a battleground. The volume is already ticking past 17 million shares in just the first 90 minutes of trading, which tells us that the institutional rotation we saw begin late last week is not slowing down. This isn't just retail traders buying the dip on Robinhood stock trading apps or throwing loose change into fractional shares. This is heavy accumulation. The expectation was that the post-Gelsinger era would be a vacuum of leadership, a period of chaos where the company would be chopped up for parts. But the reality is that the aggressive restructuring and the newfound discipline in the foundry business are creating a floor that the bears simply cannot break. When you see a stock refuse to sell off on bad macro news, and we have had plenty of jittery inflation data this morning, that is a tell. It is a tell that the sellers are exhausted. The weak hands have folded. Everyone who wanted to sell Intel at $25, $30, or $35 has already left the building. Who is left? The believers, the deep value funds, and the massive passive flows from Schwab Intelligent Portfolios and Fidelity Wealth Management accounts that are forced to rebalance as the market cap swells back toward that $200 billion mark. Let's back up and look at the immediate context of this price action. The stock opened this morning at $40.73, briefly pushed to a high of $41.26, and then settled into this tight consolidation range around $40.31. This coil pattern often precedes a breakout. Traders using Interactive Brokers trading platforms are likely seeing the implied volatility compress, which is the calm before the storm. The expectation for today was a pullback. After the monster run we have seen over the last 2 months, driven by the Apple Foundry rumors and the finalized CHIPS Act capital injection, it would be perfectly natural, even healthy, for the stock to retrace back to the $38 level. But it isn't. It is refusing to give back ground. That tension between the expected technical pullback and the reality of this stubborn bid is where the opportunity lies. It suggests that there is a massive bid sitting just below the market, likely from sovereign wealth funds or large ETF rebalancing, absorbing every single share that hits the ask. We need to address the elephant in the room, the rumors swirling about the foundry deal. For years, the skeptical take on Intel was that its foundry ambitions were a money pit, a vanity project that would burn billions and yield nothing but delays. The expectation was that TSMC had an unsurmountable moat, and that companies like Apple or Nvidia would never trust Intel with their silicon. The reality we are waking up to in late 2025 is that geopolitical diversification is no longer a nice-to-have. It is a mandate. The speculation that Apple might be tapping Intel's 18A node for lower-end silicon or peripheral chips has completely upended the risk model for this stock. If that ink dries, Intel is not just a chip maker anymore, it becomes a critical infrastructure utility for the entire tech sector. You have to ask yourself, are you pricing NTC as a dying PC manufacturer, or are you pricing it as the backup generator for the Western digital economy? The market is trying to figure that out right now, and that confusion is why we are pinned at $40. Now pause for a second. I want you to go to the comments section right now and tell me, what is your average cost basis on your Intel position? Did you catch the falling knife in the 20s last year, or are you holding heavy bags from the $50 highs of the previous cycle? Be honest, I want to see where the pain points are, because that psychology drives the resistance levels we are about to hit. When we look at the broader semiconductor landscape, the contrast is stark. You look at NVIDIA stock, which has been in the stratosphere for years, priced for absolute perfection. You look at Apple stock, holding steady as a fortress of cash. Then you look at Intel. The expectation for a value stock is that it's cheap for a reason, usually because the business is broken. But the reality of Intel's balance sheet today is vastly different from 12 months ago. The aggressive cost-cutting, the suspension and then careful reinstatement of capital allocation strategies, and the sheer amount of government backing, billions, from the CHIPS Act that are finally hitting the ledger have de-risked the downside. If you are a self-investing individual managing your own IRA on SoFi Investing or using the Fidelity mobile app to track your retirement account, you have to look at the risk-reward ratio here. The downside, barring a catastrophic manufacturing failure, seems capped by the tangible book value and the strategic importance of domestic fabs. The upside, if they actually execute on the foundry roadmap, we are looking at a repricing event that could send this thing back to $60 in a hurry. Let's talk about the mechanics of how people are actually trading this. We are seeing a massive divergence in retail versus institutional behavior. The retail crowd, often trading on Robinhood crypto or cash management accounts, has been skeptical. They have been burned by Intel too many times. They see the name and they think old tech. They would rather chase momentum in AI software names. But the smart money, the family offices using Fidelity brokerage services, and the quants on interactive brokers platforms are building the base here. They are using the low volatility to sell puts, collecting premium while they wait for the next catalyst. It's a classic accumulation strategy. They are not buying the hype. They are buying the assets. They are buying the fabs in Ohio and Arizona that are finally coming online. They are buying the patent portfolio. They are buying the fact that you cannot build a digital future without x86 architecture playing a massive role, regardless of what the ARM bulls tell you. This brings us to the fundamental business model, which is often misunderstood. The general public thinks of Intel as the Intel Inside sticker on a laptop from 2015. That is the expectation. A company selling processors for dying desktop computers. The reality is that Intel is effectively two companies in a trench coat. One is the product group, which is fighting a brutal war with AMD for server and client market share. That business is tough, margins are compressing, and it's a street fight. But the other company is Intel Foundry. This is the sleeping giant. This is the business that competes with TSMC and Samsung. By opening their factories to external customers, Intel has fundamentally changed its total addressable market. They are no longer just betting on their own design team winning. They are betting on the entire industry needing capacity. If NVIDIA needs chips and TSMC is booked solid, Intel wins. If Amazon Web Services designs their own custom silicon and needs a US-based manufacturer, Intel wins. This hybrid model was mocked initially, but as supply chains tighten up, it's looking less like confusion and more like insurance. The history of this stock is a masterclass in hubris and redemption. We all remember the dominance of the 90s and early 2000s, where Intel was the undisputed king. Then came the lost decade. Missed mobile cycles, failed 10-nanometer transitions, and a culture that became too insular. The expectation was that they would go the way of IBM, profitable, sure, but boring and slowly shrinking. The reality check came hard in 2022 and 2023 when the bottom fell out. The dividend cut was the final capitulation. It was the moment the company admitted, "We are in trouble." But in the stock market, the point of maximum pain is often the point of maximum opportunity. When the dividend was slashed, income investors fled. When the AI boom started and Intel looked flat-footed, growth investors fled. Who was left?